Welcome everyone. My name is Kamal Manocha. I represent PMS AIF World. In the rhythm of weekly webinars, today we have Mr. Anirudh Garg from Invasset. Invasset PMS, has given a surprising 100% equivalent return in 2023. It's like sounds to be unbelievable. I did meet Anirudh, in my last trip in Mumbai, and then try to deep dive how has this happened. That meeting was short, but this webinar is to have a detailed discussion with him to understand the detailed process as well as to deep dive the strategy. It will be very interesting webinar as I have interviewed many fund managers, and I look forward to doing very different kind of a discussion because Invasset uses algorithms, and these algorithms have evolved over last 2.5 decades. So we'll talk more as we continue this discussion. Welcome, Anirudh, to this webinar. So foremost, I congratulate you for this astounding returns in 2023. I wish we had started recommending about your PMS 1 year ago, but it seems that now asking our clients to look at your PMS could be maybe coming at a peak, coming late. So that's something which worries us as well as our clients, and hence it is important to understand how robust is your strategy. Was 2023 just kind of a lucky year for you, and we do not want to be unlucky in 2024, right? So that's a very sincere and honest, I would say, consideration which I have in my mind when I'm going to start this discussion with you, and hence I want you to give your opening remarks that what actually happened in 2023, how have you been able to generate such high returns, and then we'll continue discussion from there.
Okay. First of all, thank you, Kamal, for having me on your show. It's a pleasure indeed to be here again after exactly 1 year. I think it was 15th of January last year at 2023 when I was here. So I'll take my conversation on from there. We did not do anything, I would say, out of the box in 2023. The returns that we've got in 2023 was just because of our basic principles. Invasset's algorithms, as we say them, are based on two very basic principles. One, they are the beliefs about the market. The first belief is that the markets are always future looking. They discount the future. Okay, you do not have to come into the market and see what is being happening in the market, the results that are out. You have to predict what is going to happen in the market for the next 1 year based on what is going to happen in the next 2 to 3 years. Markets are always future discounting. And the second point is the reason why which we were awarded with these returns that we've got was markets, they punish biases. If you create a bias in the stock market, be it any type of bias, be it like the investing style bias, or be it the market cap bias, or be it a sectoral bias, these biases are generally punished by markets when the trend changes. So only these two factors we have kept in mind and just went on doing what we were doing, and these are the returns that have come to us. Though I mention it again and again that 2023 was a year of extraordinary returns. These years generally are led by a year where the returns are not that great, though they are industry beating as well, but they are not as great as the previous year. So please keep that in mind. And any investors, please do not choose your fund managers based on last year's returns. That is not a very good way of choosing your fund managers. It is your psychology. Your psychology should match with what the fund manager is offering or what he is going to invest in. At Invasset, we believe in bias-free investing, and that is what we have been focusing on. When it comes to being lucky for the year, yes, we were indeed lucky. Whenever you're successful, luck does have a role to play. And apart from that, the hard work that goes behind getting that luck in place is also there. If we talk about the returns, our 3 years, look at our 3 years CAGRs, it's around 40%. Our 4 year CAGR is also around 40%. So we have been regular compounders. Yeah, this year was quite extraordinary, not only for us, but a majority of mutual funds and PMSs and AIFs out there.
Sure. Regular compounders kind of is a kind of, I would say, a statement which makes me kind of recall consistent compounders. But at the same time, I really want to deep dive beyond luck, what happened and how were you able to actually generate these returns? Because you mentioned that you did not do any changes in your portfolio in
Mhm.
entire year, and we did this, I remember, discussion in January last year as well.
Mhm.
So I'm just trying to understand your portfolio, as it was at the beginning of 2023, it remained same, you did not make any change.
Not more than 2-3%, yes.
Okay. So how was your portfolio actually so much aligned with the upcoming trend? So what happened in 2022, and how were you able to actually align your portfolio, which was so conducive for a unusual year like 2023? Because in 2023, as per my understanding, all top fund managers, which are managing maximum of the AUMs, which talk about quality, which talk about growth, which talk about investing maximum into financial services through private banks, or even sectors like IT, pharma. These are some of the I would say loved sectors of last whole decade. These sectors have not performed at all, but something which performed was like PSUs, infrastructure, and those stocks and those sectors which people did not have exposure in. And then you are saying that you did not add these sectors and stocks to your portfolio in 2023, they were already existing in your portfolio in 2022. So this seems very unbelievable. And how were you able to assess this so much in advance, that this change of trend is happening and you were prepared for that? That's my ultimate question which I want you to address.
Okay. So at Invasset, we believe in something called a two-run theory. It has been, so I'll explain what this two-run theory is. It is a very generic theory. It is not something that out of the box or out of the hat that we have pulled. The world is divided into two type of runs. The entire world, it operates, the stock market world, it operates on the interest rate scenario. So if we analyze, so part one is an old economy run where you have high inflation, high growth, and then higher commodity prices, um, and rising interest rates, and things like that. And on the other hand, all these factors are lower in a new economy run. A old economy run focuses more on value. A new economy run, it focuses more on quality. And then the sectors that do well in an old economy run are sectors like either they are interest rate sensitives. Then there are two things that guide an interest rate sensitives is that the global growth is there and global inflation is under control. So what all sectors do well if these things are right? The sectors like metals, real estate, autos, these sectors do pretty well if the scenario is okay. And the other theme that you have in an old economy run is the capex theme. In a capex, what you need collections by the government and the intention of the government to spend. These are the first two primary indicators of capex. And if global growth is there, then the private capex also comes in. On the other hand, and what sectors do well in the capex theme is defense, then railways, infrastructure, and all these sectors which are concerned with the overall nation building, and lenders to these sectors like public sector banks. On the other hand, when you are in a new economy run, you're looking for quality. Quality comes in a few sectors like, say, pharma, FMCG, IT, retail lenders, white goods. So these are the sectors that do well in a new economy run. Now, when does the shift happen? The shift happens when one sector becomes overly exuberant to its historical averages. What we at Invasset have done is we have had 35 years of day by day data of more than 170 plus parameters working simultaneously on 1,800 plus companies that help us determine what are the valuations, what sectors you need to be in, what stage. We have a four-stage process here at Invasset in which we do value investing, growth investing, quality investing, and pension fund investing. So this circle keeps on rotating at Invasset on an algorithmic basis. And these algorithms, Kamal, are not very complicated high frequency trading algorithms that a normal layman would not understand. They are just our experience modified into a code so that when we are batting on the pitch for our investors, we as humans do not succumb to the biases that our algorithm is made not to succumb to. Yeah, so just with the help of a code, just with the help of a set of rules that are being consistently jiggled to every day, and then giving you final data, and then you are taking your decisions not biased in any way. Yeah, so that is how we were able to do it.
Sure. So, we have discussed the history, but let's now maybe focus on present.
Hmm.
So, are you still, keeping your portfolio same, or your algorithms, or your last, you said 35 years of, evolved algorithms, throwing some again changing trend happening? I am interested to know more now onwards on this aspect as well.
Okay, to do that, Kamal, I would need like 2 minutes of explaining the algorithm, what is it. Otherwise, your viewers would not be able to understand what we are talking about. So, okay, at Invasset, when I said that we are opposed to biases, our first uh, view was to eliminate the style of investing bias. So there are particularly four types of biases, four types of investment styles out there. Primarily, if you take in 90% of funds and fund managers, first is a value investor. A value investing style is one in which you calculate the discounted cash flows and try to find out the intrinsic value using various such models. You invest below the intrinsic value, and you take out your money above the intrinsic value. So to remember this, in say there it is in quadrant one of your square, and there is who used to do this? Benjamin Graham used to do this, the father of modern investing. So let's imagine a Benjamin Graham on quadrant one, and quadrant two is when the quadrant two is where growth investing is. Growth investors, what do they believe? They believe that the stock market has a bull run every 3 to 4 years, and this bull run is taken over by new leaders, either in terms of stocks, sectors, or groups. Why? Due to some change that has happened in the broad environment, and one has to analyze that change and assess its implication on the top line and the bottom line of the companies. And these are the stock sectors or groups that will lead the next bull run. Third, in the quadrant three is imagine Warren Buffett, who's doing quality investing. What is quality investing? You take high prudent managements, high ROCE, high ROE, good free cash flows, companies which have sustainable moats with them, either in terms of products, distribution lines, innovation, way of handling business. They are leaders in the market share, or even incremental market share lead. They are leading the most. And sometimes you get companies which are disruptors. They come and disrupt their the I would say the business or the market as a whole. And in the fourth quadrant, you have pension fund investing, where you have goals like, okay, that my capital is very, very sacred. You do not increase my capital much. Give me a little bit of alpha on what the risk-free rate of returns are, and rest I will manage. Please do not decrease my capital. So four investment styles: value, growth, quality, and pension fund. What we have done at Investment is we have combined all the four. कि हम एक ही क्यों करें? Why not all four at different points of time, without exactly timing the market, but broadly timing the market? To pinpoint exactly time the market is difficult, but broadly you can make a multimodal model where you know that, okay, the markets are in this zone, and this is the most prudent way of investing at this time. Okay, so we do value investing only when there is overall value in the market. By overall value, we mean that when the markets have fallen and the fear factor is at its maximum. And why we do value investing there? Because that time what happens is that good brick and mortar businesses, good blue chips, they are available at tremendous discounts. When there is fear and you are getting surety and safety and sahara of being good companies, brick and mortar companies, blue chip companies available at historic discounts, those are very good bargains. So at Invasset I had very quick money is made when you buy these companies at historical low valuations. When we move to trend two, when the markets they resume their new bull run, we move into trend two, which is the growth phase. I already told you, look for new leaders for the next 3 4 years. Here, 50 to 60% of our resources are working, and in this we have developed something called a relative change rewarding criteria. Relative change rewarding criteria. What does that mean? We believe that markets are constantly asking one question, that how is a company gonna perform in terms of their like in terms of their profits and top lines from now on. Whatever has happened till now has happened. How will be the next 3 years be? As the question Kamal asked me in terms of the how stock performance would be. The market is constantly asking, what is the growth that you are going to give us in terms of your financials for the next 2 to 3 years? Okay, so relative change is what market rewards, and that is what we are trying to find out. Now, to find out relative change, we have had 170 plus parameters, as I told you, working together for 118 plus 180 plus 1800 plus companies. And then in the end, we try to get you a list of top 100 companies where relative change could be the maximum. Okay, now we have these companies. What is the speciality about these companies? These companies, you will not, when you find out a company, the first thing as a research analyst you do is to check what are other people saying about it. What are other research about houses saying about it? There's no shame in saying that we read other reports as well. And when we go online, out of 100 companies, for 95, we do not find a single research report. So that is this is the primary thing. Even if it, Kamalji, I would like to emphasize here that sometimes for large caps also we have seen companies where there were not research reports in the last 1.5 year, because these companies go into a dull zone and then they are recovered back due to some changes that have happened for that industry. Yeah, so now we have the top 100 companies, our research house, which comprises of more than 12 people, specializing in their various fields, having experience of minimum 5 years to 30 years. They analyze those companies on a negation criteria. Negation criteria means that, okay, uh, for me, the company by hypothesis is okay. You tell me what is wrong in this company, what my algorithm has told me. What is the wrong in the company? And then if they're able to come up with something, they meet the managements and everything. If they are able to come up with something, it's okay. If not, we go in and buy that companies. So this is how our stage two goes. And then in stage three, when we feel that the markets have now, from a new bull trend to a quadrant three, the markets have now become expensive. Currently, for the last 1.5 year, as you were asking, Kamalji, from November 2022 till today, we are in stage two. But we feel very, very strongly that we are going to enter stage three very, very soon, maybe by the end of this month, next month, or the next to that, but very soon. Yeah. So stage three, we go in for quality companies. Now, what is the psychology when going to stage three? You could ask me, now the markets you yourself are saying is expensive, and why are you moving in stage three and buying in something? Why not exit the markets here? Markets are expensive, but at a valuation that can be sustained for a couple of years. We saw markets were expensive from 2018 to 2020. 3 years the markets were expensive. So what are we going to do here? We are just going to expect a 15 to 20% return from the market. And if a fall comes, if a bear market comes, our fall in our portfolio should not be more than 20% as well. So with this premise, we invest in all those Warren Buffett type companies that I told you earlier. And stage four, every 4, 5, 6 years, there comes a stage when the markets, they become exuberant. All of us, there are a lot of factors that go into researching how these stages comes, and we have a index which we call the Invasset Greed and Fear Index that guides us on what broad stage we are in. But a normal layman, like a normal investor, can also recognize, but should be alert enough. Like when your panwalas, your drivers, your friends in a cocktail party, you're just talking about stock market. When this stage comes, the risk reward ratio is not in the favor of staying in the markets. Then you should take a call, like what we do. That time we move into ultra low beta shares, which have a maybe sometimes have a reverse correlation with the market, or we move into uncorrelated assets like the US dollar or gold. Or if the hedging options are very, very cheap, please do keep an eye on the hedging options this time you are getting, because there were so many writers of options in the markets that the option premiums in the markets have reduced too much. So you can take an advantage of that. Not a recommendation, just guiding you how things work. So all these four together is a stage how Invasset works, the entire process through which Invasset works. And now Kamal was asking me that what is the scenario now? As I told you, we are believing that we will move to stage three very, very soon. And then what happens is that our downfall is limited to 15-20%. Yeah, if the market continue their run, we'll keep on enjoying the run, and a 15 to 20% total return per year CAGR we can expect for the next couple of years till they remain expensive. And then again the process goes, and if in the process they become exuberant, we'll take the stage 4 call.
Sure. As per your history of 35 years, is it possible that any stage surpasses the stage in between? So, for example, from stage 2, straight away stage 4 comes.
No, we have never seen that. We have seen where stage 4 does not come and you are stuck in stage 3, because stage 3 we move very, very soon. Some time of exuberancy has to be created in the market. We are not, Kamal, we are at Invasset are very, very clear that I would say the joy of making money is not as big as the pain of losing money. So we are very, 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 alert to the fact that as soon as we receive the very early signals of exuberance or expensive, not exuberance, very early signals of an expensive market, we move our stage and take our stocks to very, very quality stocks.
Sure. So, like, you're expecting now stage 3 to come, and then, you will move from, say, value to quality. You mentioned that in next, say, 2 months that could happen. So, have you already started researching what kind of quality you will enter into? And can you please explain with some examples that what kind of change will you make, say, in one particular sector, from what type of stock to what type of stock?
Okay. So, though it would be very premature to tell, because that is something that is going to happen, and we are in that process. So, I think it would not be very prudent for my investors to declare something on I would say, a television or a thing that is followed so nicely by people. But yeah, I would like to mention here is that if I was holding something like Punjab National Bank till now, I would actually shift to a HDFC Bank. Does that answer your question?
Absolutely, yeah, yeah. So, and moreover, we are discussing all this just for learning and understanding, and this is the
Yes,
context. Obviously,
absolutely. But we are actually we are in that stage right now. Otherwise, I would have, us at Invasset, we disclose everything that we are holding. But right now, since we are at that point, so we are not able to do that.
sure. And you mentioned that in couple of months that stage would come. So, what are those drivers that you will continue to see over next 2 months, which may tell you that maybe it is coming even sooner, or it may get dragged for 3, 4, 5, 6, 7, 8, 9 months more?
It all depends upon the market performance. To get the markets to get expensive, there is only one way, that the markets have to rise and enter a zone where all the historical valuations, the problem is that when a layman goes in and analyzes these things, you depend on a single factor model. If you are making a multi-factor model like we do, somewhere in the net it gets caught. Yeah. So when suppose you have 15 factors analyzing that, or 20 factors analyzing, which is a very basic model, analyzing whether the markets are expensive or not. But in those 15, 20, you see that, okay, out of 20, six have happened, which says that these six were factors were there when the markets were expensive in all the last 15 instances we have. So then you can gauge that, okay, now depending upon my risk reward ratio or depending upon my risk appetite, I can take a decision whether to stay in growth or whether to go into quality.
Sure, you mentioned 35 years of history of evolution of your all algorithms, but your PMS has 3-year history. So I want to understand, before your PMS licenses came, and I think you're referring to your proprietary portfolio management. So given that entire history and data, can you kind of explain or share that has this happened in the past, that a portfolio was holding, say, quality stocks or growth stocks? Because at present I understand your portfolio is leaned towards small caps and mid caps and value, and you are saying soon you may add quality, but in the past also this has happened. And can you please give me
Oh,
evidence and example of when did this happen?
oh, all the time, Kamal, all the time. So I remember. Let's first of all, our portfolio is 4 years old and not 3 years old. In terms of Invasset's performance, you can check it from Kamal's website only. And then when it comes, I'll tell you. So it was 6th of June. 2021, when we shifted to quality, let's not go into our proprietary thing because that would not be very prudent, because those figures are not in public domain. And then 9th of September 2021, we went into the exuberance phase, the stage 4, the pension fund stage. So this is something that we have done live for our investors. And then we again came back into stage 1 when it was the Russia Ukraine war, so around end February or early March 2022. And then November 2022, we came into stage 2, that was the growth phase. So I've
Sure.
given you all the 4 stages together. And before that, when we started on 8th of January 2020, we were in stage 3. Stage 3, that is the quality phase. In that quality phase, we saw a drop down of around 26%, 27%. When the COVID came, everything got smashed. The Nifty itself fell 32%. And then from there, our stage 1 started. Then August of 2020, our stage 2 started, which ended, as I told you, in June 2021, 6th of June or 6th of July 2021. So this is how we have done it. And it is very natural, Kamal. You just have to, everybody can set their own parameters doing these stages, but just stick to those parameters and do at least a 35 years of history going backwards.
Sure. So let's further understand stage 4, because stage 4 is something which again is catching my attention. You mentioned that you in 2021 also got into stage 4, and then you mean to say that you were sitting 100% on cash?
Yes, in 2021. So what we did was we were sitting around 75% in cash, and we did around 25% of our portfolio equally between the US dollar and gold.
Okay. And during that particular period, markets corrected and then market recovered also.
So if we talk about the exact dates, so we sold at something around 17,600, 700 levels. Market then went to 18,600 levels. Then they came back to 16,800 levels, and then we invested back. So we cannot sell at the top. We are not those expert technical analysts who can, if there are any, to sell at the top. Yeah, as I told the investors earlier, that we can just analyze broad ranges. And my focus is, I'm ready to leave the last 20% on the table, but I am not ready to be the one who will make sure, for whose the investor returns are depleted, because I'm very, very concerned about the pain that happens to an investor when the money is depleted or money goes down.
Sure. What is your general, view of year 2024? As you also mentioned, giving the disclaimer that yes, 2023 was a very a kind of a unique year, and not every year can be as great as 2023. And I see, you said that your PMS has 4 years of history and a CAGR of around 40%, and 2023 has delivered a 97%. So which means, the massive contribution in that 40% CAGR has come in 2023 itself. So obviously, one such great year, has been there. But yes, 2024, 25, what are your general views with regards to your own approach going forward in terms
See,
of?
historically, I am a data man. I would only talk data. Historically, the year 2024 should be a very volatile year. Volatile in the sense that the markets and the stocks and your returns would move up very quickly. They would come down very quickly. Dips, if are there, should be used for buying. They are very, very good opportunities to enter the market. There will be deeper, I would say, cut downs also. So do not anything. There are very for a normal investor, I would say, every time, if your market is a leading market in the world, you have to set your factors right to see if it is a leading market in the world. Every time the market approaches a 200-day moving average, it is a very good opportunity to buy. Yeah. So this year we believe that there will be deeper cuts as well and sharp rises as well. So I believe that this would not be a market to buy on breakouts. it would be a market to buy on dips. And for people who are doing SIPs, keep doing it. No other way, better way to approach the market than doing SIPs. Whenever there is a very deep correction in the market, you may increase your SIP amounts, or um, like two or three SIPs. If you have a capability, you have savings, you can in deeper falls, you can just go in and invest more than what you normally do.
Sure. So, for my understanding and for the understanding of audience, when
Mhm.
we say that your portfolio approach is dependent on algorithms which have evolved over 35 years of history across 170 parameters, does that
Mhm.
mean that when you add a stock in your portfolio, which is like, having say 10% weightage or more, you will not even meet management at all?
No, it's not like that. First of all, we do not add more than a stock which is more than 4%. Like, never add. Initially, when the sale starts, we do not add more than 4%. If you see some stocks in our portfolio which may we have shared with you, if it's more than say 8%, 9%, it's because the stock itself has multiplied by 3, 4 times. So never more than 4%. First point. We have very, very specialized research team. Few of our team members, suppose the person who manages our cement division, cement sector, cement and infra, has actually worked with Ambuja Cements before. Yeah, so we have experts in the field. Anywhere feel that we need to meet the managements where things are not clear, there is no other way out. Either we meet some sector expert or we meet the managements.
Sure. So you also mentioned that you have, 8-member team, right?
12-member team for
12 members.
research. Yeah.
So what do these 12 member, differently do?
No, they do not do anything differently. In the stock market, you do not want to do things differently. What they are given is a different set of companies to research on than what a normal research team is doing. Nothing else. They're just doing their things very slowly, very boringly. Just they're given different set of companies from the algorithm based on relative change to research on. Yeah, they have to do a little bit of more hard work than the normal people who are researching the top 100, 200, 300 companies, because as I told you earlier, that the companies that they research on are not very easily available, or the data is not easily available.
Sure, Anirudh. So, this is an election year, and does your algorithm also have, because you said 35 years, any views and any perspectives on what happens generally with regards to these four stages in an election year, or that is something which is not covered in your overall thesis?
No, Indian elections are a very, very important factor for the markets, but you know where the market is currently is a much more important factor. Yeah. So if we talk about, say, 2009, when the Manmohan Singh government was elected, we saw a two double freezes, upper freezes in the market. Yeah. Why? Because the markets were recovering from their 2008 lows. It depends upon where the markets are. Yeah, so elections, no doubt, they are very, very important for a democracy of 150 crore people like India. But it more depends upon, it is more of a very, very important event, and which shapes the, I would say, the psychology of the investors at a large, like the Ram Mandir event was. The Ram Mandir event for us was a very, very significant event which has shaped the psychology of the investors on a large towards a positive frame of mind, that India is doing something great, something that was not done in India the last 50 years. Of course, India is progressing at a much larger pace than what was happening. But yeah, when you come down to reality, things are just X plus Y that are happening. It's not X raised to power something that is happening in India. So yeah, that is things like after the Ram Mandir event, as I told you, we feel that the markets are now turning into an expensive trajectory, though we have not taken the event into mind. But of course, the market valuations and all the related factors, they start on indicating things like this. In the last 1.5 year, whenever you have talked to me, I think it will be the first time that I am talking about markets turning expensive, if I'm not wrong.
No, absolutely. That is what I am wanting to kind of deep dive further. That is what I was going to ask further.
Hmm.
So, who will take this decision of converting your portfolio from say current type of businesses to quality? You yourself will take, investment committee will take. Who all are part of that investment committee, if at all investment committee? How will that happen? How will that change happen? Will that happen in 1 week, 1 month? Can you please explain that full process?
I will tell you, first of all, the decision has to come from the Invasset Greed and Fear Index that, okay, now the conditions are ripe for stage three. Okay, then the companies would come from the relative change rewarding criteria as to that these are the companies which are the companies of the stage three, in the sense that these are the companies which are having good managements, these are the companies which have good ROCE, ROE, free cash flows, they are the market leaders, they have incremental market share, and apart from them these companies can, यहाँ पे एक और फैक्टर आता है कमल, that these companies should be growing companies and not very expensive also. They can be expensive, not but not exuberantly expensive. Suppose today came in a Zomato IPO and it perfectly fits stage three, but it comes at a valuation which is not supportable. So those companies would automatically be charted out. Again, that same research team will sit down and then analyze that, okay, these are the companies that are out there. Let's pinpoint each and every point of the checklist that is out there and buy the top 25 companies that fit our criteria. 2 years before, when the stage three came, maybe the companies that were there have now become very expensive, or maybe the companies that came there, they have lost their growth thing. The growth is not there. So, taking all the considerations in mind, then we will make reports on 25 companies and we would go ahead by buying those companies. Anirudh Garg, as a fund manager, is just overseeing everything and not taking any decisions according to his whims and fancies.
Sure. So, if you're talking to investors who are kind of sitting on liquidity and they are wanting to invest into Indian equity markets for future wealth creation,
Hmm.
and you're sounding relatively pessimistic, so that investor will say let's then wait and then invest once markets look kind of again attractive. How will you answer to that investor? Because future is unpredictable. You will have to explain it in detail now, the pessimistic view, because that can lead to investors kind of getting into a procrastination zone, which is the most risky zone, because it's an election year and market can continue to keep going up, sectors could change, right? But the thing is, there may be a possibility of as you said, a little consolidation of 5-7%, and market again goes up and investor misses that opportunity. So how would you address this particular aspect? Because I do not want investors to kind of get misled by your I would say relatively less optimistic or to an extent pessimistic stance.
Okay, so what I'm saying here is that I am positively cautious, not pessimistic at all. As I said in stage three, what what are our expectations? Our expectations are 15 to 20% CAGR. 15 to 20% CAGR, let's assume a middle way. 18% CAGR means that your money doubles every 4 years. If an investor is not happy with the 18% CAGR, I think stock market is not the right investment tool for that particular type of investor. 18% CAGR can make you very, very, very rich if you can compound it year on year. So, inexpensive markets, if you are my duty as a fund manager is to set the expectations right. I do not want to give unnecessary expectations to the investors and say that, okay, come invest in my fund, and then if their expectations are not met, they say that the fund manager is not the right person and they do not have a, for us, speaking and talking what is right is more important. We believe according to, we may be wrong, we have the very much right to be wrong. We do not have something like a holy grail. We can be wrong, and okay, we may the markets do have a right, and I sincerely wish that after we move to quality the value keeps on going up. But yes, I have to take decisions based on my historical judgments and my things that have proven for us in the past. Yeah, again, we are positively cautious on the markets. not in terms of the growth. We are very, very happy with the growth. The growth is going to continue. You will have 15 to 20% CAGR in quality for us. But yes, there, as I told you, tremendous money is made if you follow the things properly. If there is a fall, invest more. If there is a rise, you may want to book profits to some extent. And if you're able to do that, a lot of money can be made. It's not that the alpha creation opportunities are gone. It is that the alpha creation opportunities have changed, would change their course. That is what we believe.
Sure. So let's say in 2 months, stage three comes. You move to growth. You move to quality.
Hmm.
And then, as per your historical data, that stage can continue for how long?
Oh, it can continue from 3 months to 3 years.
Okay.
Yeah.
Sure. So it has your data conveys that.
Yes, absolutely. Absolutely. It can continue from 3 months to 3 years. Nobody can judge them is going to happen in the next 6 months, 1 year. 2 months also, I'm not sure if the market stays here for the next 6 months. Market takes a pause for the next 6 months. We may not shift. It is just that the momentum that is going on, we believe that it may, but if not, it's actually currently is a very, very good period to invest. The next 3, 4 months for the market, I believe, should be very, very good. But when
Sure.
we have to take the entire year in account, we have to take the past year in account as well. So based on that, a little bit of caution, it's good to exercise caution sometimes.
Sure. Anirudh, I have also heard in a couple of client meetings, you have mentioned that you, at your personal level, when your dad, Mr. Rajneesh Garg, who kind of has been the main person behind the evolution of entire framework, uh,
Mhm.
under his leadership and decision making, transformed or maybe grown a couple of lakhs, I think 10 lakhs into more than 200 crores over last 3 decades.
Yeah.
Obviously, mathematically, with compounding, it is understandable. I can believe that.
Mm.
But, can you please explain that full thing, in this webinar for our audience? Because I want investors to have this understanding that, giving money to an experienced fund manager, be it any stage, is a better idea than waiting for a maybe lower level to come. Because what happens, if investor kind of starts taking decision on his own in terms of trying to time the market, ultimately, in my opinion, he will come and invest at a time where he has actually kind of undergone some loss of opportunity. So because at the end of the day, we are living in a economy which is growing at 12% nominal GDP growth, right? So obviously, keeping that in mind, I want you to kind of explain, because from your point of view today, on one side you're managing public money in your PMS, parallelly you have your own personal 200 crore portfolio. So given your own understanding of market dynamics in terms of valuations and these stages, I'm sure whatever you will do in your portfolio is what you will do in client's portfolio, right? So more
Absolutely.
than any client who's going to invest a couple of crores, it is you who has a very large portfolio, will be concerned about how to take decisions. And such, I would say, times would have come in the past as well. So how have you sailed through those times? What was that story? How will you kind of pass through these times from stage 2 to 3 to 4, is what I want you to explain.
Okay. So see, when you have a set of rules that are giving you an update every day, after a certain period of time, you do not care that what stage you are in. You know that there is a right way of doing things. There will be times, every time when these stages come up, Kamal, they give us a surprise as well. So back in 2018, the stage three used to generally last for 3 to 4 months or 6 months, maybe not more than 7 months, 8 months. But in 2018, the stage lasted for 3 years. So every time we are here on the pitch and these stages they come, they give us a different surprise altogether. But when we make sure of two things: that is the framework right? Is the framework generic? Is it not something that would change with the market changes? You know, markets have evolved from 1987 till today and has seen everything from Harshad Mehta to dot-com bubble to 2008 financial crisis to 2020 COVID crisis and all those minor falls in between. Now, if it is able to live up to those uh, falls, the point is it will be able to live up to the next ones also. Why? Because it is very generic in nature. What are we doing as the markets are increasing, as the markets they rise in their value and the valuations overall in a multimodal model? We are just reducing things like we're reducing beta, moving into quality, moving into more quality, moving into uncorrelated, things like that. And there will come a time where you will feel that your decision was wrong. Okay, so from 2018 moving into quality, a decision was not very great, but we kept on doing what we had to. And when 2020 came, no doubt that those, as I told earlier in many of our client meetings, that those were the only 3 years when we could not make a 24% CAGR. But after that, we again it took off. So you have to just stick with your thing, follow your follow your set of rules. Anybody can make their own set of rules. I would advise in the market is that just make your rules, test them in the past, over time, over and over time, work hard on them. But the major hard work is when you have to follow them on the pitch. The ball that is going out, you do not have to medal it. You have to leave it no matter what over of the match it is. So just keep following your rules. We keep on doing that. Yes, when you were asking, should a professional advice be taken? I think I've also learned it the hard way. Wherever professional advice is available, Kamal, we should always take it, because that particular person has done a lot of research and put in a lot of time in making things done. Why do we go to a why do we go to a tailor to get our clothes made, or why do we go to a shoe shop to get our shoes made? Why not make them ourselves? Because ultimately we know that these are the people who specialize in a particular field. And stock market just attracts everybody. Thinks that I'm smart enough, and people are. You will find more smart people coming out. But yes, for a person who's busy in their day-to-day work, busy in their jobs, busy in their building their businesses, busy building India. If they have to opt for investing, I think the number one place is mutual funds for a retail investor, and then alternates. They will provide a very attractive, I would say, opportunity for HNIs in the next 2 decades to come in this growing India.
No, sure, absolutely. Point well taken. We are coming to last 5 to 7 minutes of our conversation, whereby, I want you to maybe spend time and cover for the audience, for them to learn and maybe create their own framework to follow, as you mentioned. From your evolution of framework, that what are those 170 points, which you follow. I'm not saying you cover 170 points, but broadly speaking, you have in bits and pieces covered one aspect again and again, which is valuations.
Hmm.
Second aspect you covered is interest rates,
Hmm.
right? So, what are the other aspects around which those 170 points, are what your algorithm follows?
Okay, so now you're asking a human to give those 170 points. I'll try to make up a story around them, okay? So that it remains with our dear investors who have given time and listening to our podcast. So first is the global scenario. You have to check the global scenario. We are all a connected world now, and you have to check the global scenario. First of all, global scenario in terms of how the global growth is. Okay, global growth. Today, the global growth is dependent primarily on two countries, USA and China. How the global growth is happening in these two countries, you need to evaluate them in as much detail as possible as you will analyze the Indian growth. You cannot work simultaneously India grow kar raha hai and leave global growth aside. Then you need to check what global inflation is doing. Global inflation is very important. Why? Because at the end of the day, please remember that the US Fed is the BAP of all central banks. If the US Fed sneezes, all of us catch a cold. Yeah. So what they do is they analyze everything in detail, analyze them for the past 20 years. What have they said? What has happened after that? What were the implications in the market 1 year, 3 years, 6 months down that? So US Fed, and especially the US Fed, not the Chinese Fed. I've not seen them being very consistent. US Fed is a very consistent body. They walk the talk, and whatever they say happens for the next 6, 8, 12 months. Okay. Then when it comes to uh, geopolitical and local government policies. For example, it changes everything. For example, a geopolitical policy change was when China said that we are not going to make chemicals anymore. Yeah, so it changed the entire story for the Indian chemical industry. Yeah, and then maybe Indian thing was when the Indian government decided to go in for 19.5% of budgetary expenses in capex in last year's budget, which was the highest after 2005. So you should have data कि capex हर साल में कितना हो रहा है, and how the capex is happening, and what is the amount of capex that is happening, and how much the capex is rising, and how much the budgetary normal expenditure is rising. Yeah, and then when it comes maybe a few micro factors like how are the companies turnarounding. For example, how big an impact will it be on United Spirits when Diageo would take over? So you have to extrapolate that. Or maybe a company which was elsewhere, a government company was then taken over by a private group, as it happened in the Hindustan Zinc time. And when it a lot of analysis it goes into commodities, because commodities, otherwise it is earnings when it comes to quality companies. When it comes to commodities, it is more of what are the inventory levels, what is the solvency ratio of the commodity companies, what is the price to book ratio. When it comes to you have to buy commodity companies when their PE is at the maximum. The other way around, when the PE is at its maximum, you have to get out of them when the PE is at its minimum. That is how it operates, because they operate in cycles. When the highest profits comes, that time more and more people come and they put in plant and machinery, and more they are attracted towards a particular sector, and the oversupply happens. And then ultimately the price corrects, and automatically the stock price also corrects, and they fewer move out of the business, and then again it starts, the commodity cycle starts again. So all these factors, we have a lot of, we have research 1800 plus listed companies of India. What would fit a steel company would not fit a banking company. So that is why we have around 170 plus factors working together to form a percentile ranking system. So a few changes, a few examples I tried to give you.
Sure, Anirudh. I think this was a very interesting webinar. Thank you, for sparing time today. We'll
No,
again connect maybe, after 6 months. We'll not wait for one full year to reconnect with you. Again, good wishes for 2024 and years ahead. Thank you, everyone, in the audience who kind of
uh,
took time
Kamal, I'm
out.
not able to hear you. Kamal, I did not hear you. The last thing, it got paused.
Sure, sure, sure. I was just giving the thanking remark. I was saying thank you so much for joining today, and
Oh, it's a pleasure, Kamal. Always pleasure talking to you and viewers.
yeah, good wishes to you for 2024 and years ahead. And thank
Thank
you
you.
everyone for joining in today. This was an interesting, insightful webinar. Those,
Kamal, I
yeah,
have one point to make here from some comments that come on the right when we are doing this. Uh, I can see that clients are saying, "Is it the right time to invest? Should we wait for a correction?" Uh, you know, from what can I answer that, Kamal? If
yeah,
it is okay?
please go ahead. Yeah.
Yeah. So see, friends, how we see at Invasset is that it is always a right time to invest if your psychology aligns with the psychology of your fund manager. So whosoever the fund manager you choose, you just ask them what is the drawdown possible if there comes a fall, and what is the drawdown possible when you are investing in a normal market, in an expensive market, or an oversold market, and what are the returns also possible. If your fund manager can explain you that these are the scenarios and these are the comparative returns and drawdowns, and this is how we are going to approach the markets, and if it aligns with your psychology, every time is a good time to invest. That initial 15-20%, the biggest enemy that I have learned over time for an investor is that fear of an initial 15 to 20% fall. If you are able to overcome that, sometimes I joke with my investors when they give me a 50 lakh rupee check, is that no, it's not a 50 lakh rupee check, it's the 40 lakh rupee check. And they say, no, we signed a 50 lakh rupee check. I again say, no, it is a 40 just check. And then they say, were you joking? So the point is making them understand that do not be concerned by that initial 10 lakh fall that can come in your portfolio. Be very, very bullish on the India story. We are growing at a tremendous pace, and we have got a 5 year clear signal of growth again, where the capex is going to come your way. See your ministers in terms, all IAS officers, things are changing in India. We can see India being dug up everywhere, capex is being done, and the tax regimes are changing. Foreign companies like Apple and Tesla are coming into India. So do not be, uh, do not be feel underconfident that the markets have become expensive. Just be a little tiptoed and be cautious, and keep on doing your sips and keep investing in the India story. There is still a lot of way to go. We have just started.
Sure, sure, sure. Thank you so much, Anirudh. You have opened up plethora of plethora box for maybe many more questions, but I will just ask one question. So, in your PMS, if anybody wants to invest now, what is the
Okay.
guidance that you want to give on the expected drawdown? And also, are you suggesting an STP kind of a format, or you would want investors to maybe consider your PMS in 2024 now, say in January, February, as a lump sum investment?
I always actually, I've never seen that, until and unless the markets are very, very exuberant, that going in for a STP kind of framework works. So I always opt for lump sum investments. Yeah, but we do give our investors an option. I would say anybody who's investing at Invasset PMS should actually hope for a 20% CAGR for the next 1 year at least. Though no guarantees at all. Please take that as a disclaimer. Markets are very, very dynamic and things occur here before anybody can think of it. Yeah. But please approach the markets with a 18 to 24% CAGR for a longer period of time. And you cannot imagine what will happen if you can just go on your Excels and compound 100 rupees at 24% for the next 20 years, and you will see the magic that happens. CAGR is compound growth is something which is extraordinary. Do not be bored by very, very big figures. Yeah, we grew at 40% CAGR. In future, we'll be able to grow or not? No, I know I'll always give 18 to 24% trajectory to my investors.
Sure. Thank you so much, Anirudh. It was a really pleasure conversing with you. And thank
Thank
you, everyone. If any questions have still remained unanswered, you can, contact us at our platform, PMS AIF World. Kindly, come and maybe book your appointments with us. We are one of the best in the entire industry, and we work very sincerely and very passionately to address each and every client, because we understand every client is unique, and we have been doing that for last 5 years. At present, we manage more than 1,000 crores of assets across 400 ultra HNI clients, and our discovery of such boutique portfolio managers who are equally passionate to give alpha continues. And in that endeavor, we kind of brought Invasset webinar today. Thank you once again for joining us.
And thank you, Kamal.
Pleasure.